If you want to save your first $100,000, you don't need to live like you're broke and only eat rice and beans for the rest of your life, but there are 5 things that you need to do when you get paid in this order. That way you can save that $100,000 sooner rather than later. The first thing that I want you to do is to create 3 separate bank accounts. And the reason why I want you to do this is because each one of us have different things that we're good at. Like for example, me, I'm good at how I spend my money. I can control my spending very easily, but I'm not very good at controlling my eating. I like food. When there's food in front of me, I'm going to eat it. So in order to stop me from eating, I don't have the food in front of me, or I'll just eat whatever's there. So I've learned about me that some people are very good at eating, that when they start eating, they can stop themselves before they're full. When I start eating, if there's food there, I will eat it. But when it comes to spending, I'm a much better controlled spender than I am when it comes to eating. So if you want to control your spending, the first thing that I want you to do is create 3 separate bank accounts. One bank account is going to be for your spending money. One bank account is going to be for your investing money. And one bank account is going to be for your saving money. And the reason why you want to do this is so you don't accidentally spend your investment money, or so you don't accidentally spend the money that's supposed to be saved, because now it's out of sight, out of mind. And now what you want to do is anytime you get paid, your money is going to go here. But then as soon as your money goes into this bank account, you want to automatically take some of this money and move it into this bank account, and automatically take some of this money and move it into this bank account. Many banks will automate this process for you for free. If you don't have a bank that allows you to do that, maybe you look for new banks in your area that will allow you to do that. But a lot of banks will allow you to create an automation like this completely free. And now you have a system of knowing this is the money that you can spend. If there's no money in here, you have no money to spend. The second thing that I want you to do is know how much money you can spend versus invest and save. And a simple place to start is something like my 75-15-10 plan, which says that from now on, for every dollar that you earn, 75 cents is the maximum you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now, if you're watching this saying, but Jaspreet, I'm spending 100% of every dollar that I earn. How am I supposed to now take some money aside and use it to invest or save because I don't have some extra cash? Well, I want you to think of it this way. If the government tomorrow announced that there's going to be a new 25% tax on your income, what are you going to do? You're going to kick, scream, complain, cry, and then you're going to figure out how to pay it. Same thing here. Now what you're doing is not giving money to the government, you're giving money to yourself to make yourself rich. Because now what wealthy people do, and what you're going to be doing, is you're going to pay yourself first. And by paying yourself, I don't mean going out and buying a new Gucci bag. I mean now using money to make yourself wealthy. Your investments are here to make you wealthy. Your savings are here to protect you against a financial emergency. The spending money is there to allow you to have the nice things, go on the nice vacations, eat at the nice restaurants, buy the nice cars, but this money is not going to make you rich. This money will make you rich. This money will protect you financially. This money will allow you to live your life. But you need to make sure that now you're not spending all of your money here. That way you always, no matter what, pay yourself first. You're always going to be investing your money because this is where you're going to build your wealth. Now, if your goal is to put aside $100,000, let's talk about what this actually means. Because if you're making, let's just say $50,000 a year, and now you're going to be putting aside 25% of your income, some of it's for investments, some of it's for your savings to build your wealth. That means that right now you're going to be putting aside $12,500. At this rate, if you put aside 25% of your income, assuming you don't get a pay raise, because if you get a pay raise, you're going to be investing more money and saving more money, because now when you get a pay raise, your investments also get a pay raise. But if you don't get a pay raise and now you're putting aside 25% of your income, well, it's going to take you 8 years to have that $100,000 put aside. Now, some of this is going to be in your savings account, some of this is going to be in your investment account, but now you have a solid plan on how you can put aside $100,000 in not that long of a time, assuming you don't get a pay raise, but there's more. Number 3, if you want to accelerate how fast you can put aside this $100,000, you can also let your money make you money. Because now when you're putting your money here to invest, this money is supposed to grow. Now, this doesn't mean it's necessarily going to grow by a certain percentage every single year, but you're putting this money aside here. That way it gets bigger. That way your money is making you money here. The money here in your savings account probably isn't going to grow much. Sure, maybe if you put your money in a high interest savings account, you might get some return on your money, but this is where you really want to see your money grow. And if you know how to invest your money the right way, now not only are you putting money aside, but your money is going to be working to grow as well. That way now you're working to get a raise. That way you can give a raise to your investments and you can get a raise to your savings, but then your money that you put into this investment account is also going to be working to grow as well. That way this can grow even quicker so you can hit this goal even faster than 8 years. The two most common places where you can invest your money are into stocks and then into real estate. So let me talk about both and talk about the different ways that you can invest your money and different ways that you can actually get a return on your money. When you invest your money into the stock market, you're investing your money into a company. You're literally buying a piece of a business. Like if you go out and buy one share of the Amazon stock, you become one of the owners of the Amazon company. Now, the thing that I want you to understand here, that you don't have to go out and find the next Amazon or the next Google in order to make a lot of money. And this is the first mistake that so many people make when it comes to investing their money in the stock market, is they think they have to find the next hot stock. But the reality is, for probably 90 to 95% of people, you shouldn't be investing in individual companies. Why? Because most people don't have the interest or the education or the psychology to actually invest in individual companies. Because the reality is, when you invest in individual companies, if you really want to make money, you have to first understand, how do you actually analyze a company? What research do you do to keep up with the company? How do you keep up with the numbers? How do you keep up with what the management's doing? How do you listen to the earnings calls? What information should you be paying attention to? Most people don't care about that, and if you do care about it, well, a lot of people don't have the education or care about putting the education in to actually do that. And then if you are willing to do that, the next group of people don't have the right psychology to actually manage their investments, because the reality is market crashes happen. You're going to see booms and busts. And what ends up happening now to most people is they end up losing money in the stock market, when historically over the last 100 years, the stock market has gone up over the long term. Why? Because most people start selling and panicking when the market goes down, while smart and savvy investors are buying. And it's not easy to now actually do it. It's much easier to say it than actually do it, because now when you see your portfolio in the red, it can be very scary, and most people tend to panic, and then they make decisions based off of emotions, not financials. This is why most people shouldn't be going out and buying stocks, when the next best thing is buying something like a fund, potentially an index fund or an ETF. This is where now you're not investing in individual companies, you're investing into a group of stocks. That way now you don't have to worry about doing the research in individual companies. You don't have to worry about keeping up with all the companies. And now you just want to create a system where you're automatically buying some of these funds over the long term. Every week, every 2 weeks, every month, no matter what, you're just going to keep buying. If the market's booming, you keep buying. If the market's crashing, you keep buying. The only change that you'd make is maybe you buy even more when the market is crashing, because it gives you the opportunity to buy even more at a discounted price. Now I'm going to go over a few fund examples, but I want you to understand that, one, I'm not telling you what to buy, and two, investing has risks. You're never guaranteed to make money when you invest, which is why you need to always do your own research and never blindly trust a random guy on YouTube. So if you wanted to just invest your money in the stock market, you can invest in a fund like VTI. VTI is the total stock market ETF created by a company called Vanguard. What does that mean? If you go out and invest in the VTI ticker symbol, you're investing in literally the entire US stock market. So if you buy this one fund, you're buying a little piece of a lot of stocks on our stock market, which means essentially if the stock market goes up, your fund goes up. If the stock market goes down, your fund goes down. SPY is another fund which gives you exposure to the S&P 500. That means now you're getting exposure to the 500 largest companies on the stock market. SCHD is a fund that gives you exposure to dividends, dividend-paying companies. Now, I put a little asterisk here because, as a disclaimer, I do own SCHD. And so now the question is, how do you want to get paid, and what is it do you want to invest in? If you just want to throw your money into the stock market, well, VTI can give you that exposure. If you want to invest your money into the biggest companies in the stock market, SPY gives you that exposure. If you want cash flow, SCHD can give you that exposure. Now, this is where you have to start thinking, what type of investments do you want to make and how do you want to get paid? Because most people think of investing as, I'm going to put my money into this thing and then I'm not going to see this money until I'm 65 or 70 years old. I like to look at investing like, I want to invest my money into something and start generating some cash flow now. That's why the bulk of my investments, not all, but about 75% of my investments are cash flow producing assets. That means that I buy something and it pays me with cash flow. So the bulk of my stock market investments pay me with cash flow. The bulk of my real estate investments pay me with cash flow. I like cash flow just because it gives me cash in my hand today, and I can more reasonably predict how much cash flow I'm going to get as opposed to how much a stock or how much a real estate property or how much a business is going to be worth at some point in the future. If property prices and stock prices go up, that's icing on the cake. But I just want that cash flow because the cash flow gives me cash that I can use today. And now if you're working to build up $100,000, the cash flow is putting more cash in your account, or that cash is being used to buy you more shares. Because for me right now, with my stock market investments, the things that are paying me cash flow, I'm not using that money. I'm taking that cash and I'm reinvesting all of it. So I get the cash flow from my investments every 3 months because I get my dividends every quarter, meaning every 3 months. And then this money goes right back into the market to buy me more cash flow producing assets. So every week, the way it works for me is every week I have cash going into my funds. Then most of these funds are paying me with cash flow, which goes back into these funds to buy me more cash flow producing funds. So it's like a machine that's working to produce more cash flow while I'm throwing more money in there to buy more of the cash flow, which brings me to number 2, which is real estate. Real estate is one of my favorite places to invest because when you invest in real estate, now you're buying something tangible. You buy something that you can see, feel, and touch. You buy the bricks, you buy the land, you buy the windows, you buy the doors, and then you can also create cash flow. So now the way it works is you're gonna go out and you're gonna buy this property and then you're gonna rent it out to somebody else, and then somebody, that's supposed to be an arrow, somebody is gonna come in and live in this property and they're gonna pay you rent. Now if you do this the right way, this rent should cover all of your expenses. That includes your property taxes, your insurance, your maintenance, your management fees, and cover your vacancy costs, and cover any debt that you might have, and then put some money in your pocket. Now, does this mean that every real estate deal is going to be profitable? No. This is where the research comes in because, well, right now you have a very hot real estate market, which means it's harder to find a good cash flow producing deal. Does that mean that there's no deals out there? No, it means you got to be pickier and you got to work to find the good deals. And this is where, again, that financial education comes into play. Now, should everybody be a real estate investor? Of course not. But it creates opportunity for the right people. Now, if you don't want to go and actually invest in real estate, there are funds that you can put your money in that will give you exposure to real estate properties. I have an example of one of my affiliate companies that allows you to do this down in the description. But this is where just understanding that you can get cash flow from different places, and then if real estate prices go up, well, that's icing on the cake. If real estate prices go down, well, at least you're still getting that cash flow. This is now where you have to make that decision of how do you want to invest your money. Do you want to invest your money and see the future growth, or do you want to invest your money and see the cash flow? For me, I like cash flow. That's why the majority of my investments are cash flow producing, and some are not. But you got to figure out what are the right investments for you. That way now you're working to put that money aside, but then your money is also working to make you more money. Number 4, I want you to manage your 2 S's, which is your spending and your saving. And I'll start by talking about saving because the reality is your savings are not going to make you wealthy, and your savings are probably going to lose value to inflation. If the interest rate that your bank is paying you is lower than what inflation is, your savings are effectively making you poorer. Now, that being said, that doesn't mean you shouldn't have any savings. That means you need to save your money strategically. That means you want to have somewhere between 3 months and 12 months worth of expenses saved up. Now, I know this is a big range, and the reason why it's a big range is because, well, it depends on where you are in life. If you're young, you don't have any financial responsibilities, you have more freedom to be more risky, and maybe you can take on more risk, which means you might only need a few months worth of expenses saved up. If you have kids, you have a spouse, and you're not really open to this whole idea of taking risk, and you don't like this idea of investing your money, and you feel safer with the cash cushion, then maybe you have somewhere between 6 and 12 months worth of expenses saved up. You got to find what's the right number for you, but somewhere between the 3 to 12 months of savings saved up here. Once you build that savings cushion, now you're no longer going to save money and you're going to reallocate that money here towards your investments because your investments are what's going to make you wealthy. But in order to do this, what I want you to do is look at your credit card statements, look at your bank statements, see how much money you're spending every month. Add up your rent, your mortgage, your utilities, your car payments, your car costs, your gas, your food, your eating out, your travel, whatever your costs are. Multiply the number by 3, multiply the number by 12, and that gives you a range of how much money you need to save. Once you hit that number, Well, now you can stop saving that money. You can leave the bank account there because this is your cushion. Then you can start investing that money. The second S that I want to talk about, though, is how you spend your money. Because a lot of people assume that if you can buy something, that means you can afford it. But the reality is being able to afford something is very different than being able to buy something. Because if you have $100 in your account, you can go out and buy a $500 phone. But the reality is you can't actually afford that $500 phone or the $500 Gucci belt or $500 whatever, because financing doesn't mean that you can afford it. See, when most people think of affording something, they think I can just afford the payments. But now if you really want to become wealthy sooner, and if you really want to achieve that financial success that you want sooner, and you want to have to stop kind of spinning your wheels in this financial system sooner, you got to stop playing in the same game as everybody else. And that means you're going to have to control the way that you spend your money. And that means from now on, if it doesn't put any money in your pocket, don't use debt to buy it. The only exception to this would be the house that you live in. But if it's not putting any money in your pocket, don't go into debt to buy it. So what does that mean? You want to go out and buy a new car? Great. Don't get a car payment. If you want to lease a car, okay, well, you got to be really rich to be able to do that. Leasing a car is like going and flying first class. Flying first class and sitting economy is going to get you to the same place, but flying first class is a whole lot more comfortable. Leasing a car is very comfortable. It comes with a lot of perks, but you got to have the money to be able to actually afford that. That means if you can't afford to buy that car comfortably with cash many times over, don't even think about leasing it. So if you want to get a car, buy a car that you can afford with cash. That way now you don't have to worry about the monthly payments, because now when you don't have to worry about the monthly payments, all of a sudden you're going to have a whole lot more extra money every single month, because now not only are you not putting the money into the monthly payments, you don't got to pay for the premium gas, you don't got to pay for the expensive insurance, you don't have to pay for the expensive maintenance, and now you have a whole lot of extra money every single month. Yeah, maybe you don't have the BMW anymore, but you still got the extra money which can be used to make you wealthier. And now when you become wealthy, hey, go out and buy the BMW or the Benz, and you don't have to worry about the price. So now we talked about how to spend your money the right way. We talked about how to invest your money, that way you can grow your money. We talked about how to save your money. And this brings me to number 5. If you really want to amplify how fast you can put aside the $100,000 or take it to $1 million or whatever it is that you want to hit, you got to earn more money. Because now if you want more money going into each one of these buckets, you need more money flowing in. As soon as you start doing this, you're going to love the idea of investing. You're going to see the potential growth. You're going to start running the numbers. You're going to say, you know what, this is cool. And yeah, you might start spending less. That way you have less money going out. That way you have more money to invest here. But there's a limit to how little you can spend. But there's no limit to how much you can earn. And this is where things really get fun, because when you understand this, now you're going to be looking for new and creative ways to earn more money. That way you can increase how much money you're putting here, because if you can grow from $50,000 a year to $500,000 a year, now you really can amplify how much money you're spending, investing, and saving. And the first time I say that, you might hear, Jaspreet, where in the world am I going to go from $50,000 to $500,000? Like, that's not even in the realm of possibilities. Well, this is where you have to start thinking a little bit different than what you might have been doing. Because now if you really want to start earning more money, you might have to create your own income. You might have to work to create a side hustle. Start watching YouTube videos on how to earn more money. Start reading books on how to earn more money. If you start opening your mind to the possibility that you can earn more money, now you might start taking actions on how you can earn more money. Because if we just keep doing the same thing every single day, you're just trying to earn more money from your job, maybe you'll get some pay raises here and there, but it's not going to be what you need if you really want to take it from $50,000 to $500,000. And if you want to 10x where your income is, you're going to have to start changing the way you think, and you're going to have to start changing what you do. But in order for you to do that, you have to believe it's possible first. And if you believe it's possible, well, then you're going to start putting in the action to actually make it possible. What are different things that you can do? Well, the internet has made starting a business or creating an income so much more accessible. This could be creating a product. This could be creating your own business. This could be working to provide value to other people on the internet. It could be a side hustle. You can be a freelancer. There are an unlimited number of things that you can do. Now, if you tell me, Jaspreet, I hate the idea of being an entrepreneur. I hate the risk of trying to start my own thing. I hate the idea of trying to manage that type of stuff. Well, that's okay. You don't have to go out and start a business. You don't have to go out and start a side hustle. If you really don't want to do that, then now you want to find a more creative way of how you can earn more money. If you can't do it from your job, if you can't do it from your career, can you add on a second job? If that's not practical either, then how can you increase your income? Can you get a certificate online? Can you get some sort of certification online? Can you do some sort of education that will allow you to earn more money? There's a lot of online certifications that will take some time, that might cost you some money, that will allow you to earn more money. If you can start doing these things and maybe get a new career or find a new job that will allow you to earn more money, now the key is when you get a raise in your income, you don't want to just raise your spending without raising these. That's why we're following a plan that will scale with your income, because the biggest mistake that so many people make is that as soon as they start to inflate their income, they start to inflate their lifestyle without inflating their investments and inflating their savings. So as you start to earn more money and as you work to earn more money, you got to make sure that you're also increasing this and you're increasing this along with this. That's why you want to have a scaling route where now as you earn more money, you're also spending more, investing more, and saving more. That we're always paying yourself before you go out and make everybody else rich. Next time you get paid, there are 3 things that I want you to do with your paycheck that will allow you to build more wealth from your salary. Number 1 is figure out how you can get some of your money back from the IRS. If you work a job, you get a salary, your taxes are automatically deducted from your paycheck. Well, many Americans are overpaying on their taxes, and this is where, unfortunately, it's your job to figure out how you can get some of the money back. Number 2 is figure out how you can systemize your money, or as what some people like to call it, give a job to every dollar that you earn. This is what wealthy people do. Wealthy people give every dollar that they earn a job. That way they know what to do with the money. That way they don't accidentally blow all of their money, because if you don't blow all of your money, that's going to give you the opportunity to 3, grow your wealth as well. But in order to do this, you need some money left over from your paycheck, because you're working hard to generate an income. You want your money also working hard to make you wealthier as well. And that money that you have working for you can work 24 hours a day while you can't. And this is what wealthy people understand. But in order to do this, you have to understand this. But let's start by talking about number 1, how can you get some of your money back from the IRS? Now, of course, I got to start this section with a little bit of a disclaimer, because although I am a licensed attorney, I'm not your attorney. So if you have specific tax questions, please talk to a licensed tax advisor in your area, because, well, if you mess around with the IRS, not only can you get hit with a big fine, but you can also end up in jail, and neither of us want that, right? So let's talk about taxes. When you get paid with a salary, your taxes are automatically pulled out of your salary. So if you get a job that's paying you, let's just say $50,000 a year, what happens is the first thing is you're going to pay taxes. And now most Americans will not even know or care about how much money this is, because this money is not with your bank account. You will end up with something around $40,000 depending on where you live. Now these taxes are going to be your federal income taxes, your state income taxes, and then you also have your FICA taxes. Taxes, taxes, and taxes. Now, the question that you should have is, how can you get some of this money back? Because you earned $50,000, but you only got to keep $40,000. And the way that you do that is by understanding a little bit of how the IRS tax code works. Now, the most obvious and most accessible thing that people have is, well, you can invest some of your money into something like a 401k or an IRA, because these traditional 401ks and IRAs will allow you to invest some of this money, your salary, tax-free into these accounts. You can compare that to something like a Roth IRA or a Roth 401k, because a Roth 401k and a Roth IRA mean that you invest this after tax dollars. So you pay taxes first, and then you invest what's left. Now, the option that's going to be better for you, whether it's a Roth IRA or Roth 401k versus a traditional 401k or traditional IRA, is really going to depend on your personal financial situation, because the argument that everybody likes to make here with the traditional accounts is, if you don't pay taxes today, you have more money that goes into your accounts. Your money can grow tax-free, and then when you pull your money out, well, you pay taxes at the end. And when you're 65 years old and you're retired, you're going to have no income. So now you can pull your money out at a lower tax bracket, hopefully, and have less taxes that you have to pay. That's the hope. However, there's a couple concerns with that, and a couple issues I do want to address. Number 1 is that we have no idea what tax rates are going to be in 10, 20, 30, or 40 years. So there's a chance that tax rates could be higher, especially considering the growing level of national debt that we have. Of course, that's a big question mark, but that's something for you to consider. And number 2 is, what type of income do you expect to have when you retire? Is your goal to have no income, or is your goal to have a whole bunch of income, depending on what you do with your money and your other business ventures or whatever? If you plan to have no income, then sure, that's probably a good option, because If you have no income, then just lower tax brackets. But if you plan to invest for cash flow, if you plan to start your own business, if you plan to have some career that's going to give you a big income in the future that you don't want to retire from, then that could be problematic because now you have a high income, higher tax brackets, and potentially higher tax rates. So that could be a con for somebody who's thinking about the traditional. For the Roth, the idea here now is you pay taxes today, and you know what tax rates are today. And then your money is going to grow tax-free, although it's starting with a smaller sum of money. And then when you turn older, you're ready to retire and you start pulling this money out, you can generally pull the money out tax-free, and you no longer have to worry about what tax rates are because you paid taxes in the beginning. Now, this is where, again, you got to decide, is this going to be better for you? If you plan on having more money in the future, if you don't want to have to deal with potential higher tax rates in the future because nobody knows what tax rates are going to be next year, let alone in 40 years, well, this gives you a little bit more certainty. So you just got to figure out which one's the right option. After this, the next thing you want to think about is maximizing your deductions. Now, even though you are a salaried person, it might make sense for you to go out and pay for an accountant's advice once in a while. You don't want to pay $10,000 a year for an accountant or even $5,000 a year, but maybe a few $100s every once in a while to get some basic advice on if you are maximizing your tax deductions or not. Because as an attorney who's not your attorney, who spent a lot of time studying the tax law, what I can tell you is that the tax law is very complex. And well, there's a lot of deductions out there that most people don't even know about. And this is where it's very important for you to understand if you are maximizing your deductions or not, because you want to make sure that you can get the biggest and best write-offs possible, and they are changing year after year after year. So that's the second thing you want to consider, is talking to a tax advisor. Then the third thing that you want to consider, which is the least accessible, but can give you the biggest write-offs and some of the most money back, is creating your own income as well. Working to create your own side hustle, even if you have your own job. It doesn't have to be a major side hustle, just something that you want to work on the side. Maybe it's a little hobby YouTube channel, maybe it's a blog that you want to build, it's some sort of side business. Because the reason is now when you go out to create your own income, you become a small business owner. And when you're a small business owner, you open up a whole new world of deductions. And what is that world of deductions? Well, as a small business owner, you get to deduct ordinary and necessary expenses to run your business. So let's just say, for example, you wanted to start a cooking YouTube channel to share your great recipes on how to cook carrot cakes and everything else. Well, in order to run this business, what do you need? Well, you might need a laptop to run this business. That could potentially be a business expense. You might need a cell phone to run this business. That could be another business expense, not to mention all the other carrier fees and stuff to have that cell phone. Maybe you need to do a kitchen remodel in your house to have a nice kitchen to make these videos. That could also potentially, arguably, be a business expense. You might not be able to deduct all of it because that kitchen is also being used for personal expenses, but there could be a portion of that renovation that could be used as a deduction. Again, this is where now, if you're working to create a new income, if you're working to build your own business, now you have opened up the doors to ordinary and necessary expenses that you can write off. And so now, if you are working to create an income, if you're working to build a side hustle in addition to your business, now you can finally make these deductions because, well, these deductions are reserved for business owners. But anybody can be a business owner. You don't have to be making millions of dollars a year to classify as a business owner. You could start a blog, a YouTube channel, some sort of side hustle to start trying to generate an income. And if you're working to generate an income and you're generating some income and you have some expenses, well, now you can, and I recommend you work with an accountant here, but now you can write off some of your expenses, which could help you get some of your money back from the IRS. But again, this is where things get a little bit more complicated. And I'm going to say this one more time. This is where it becomes extremely important for you to begin working with a licensed advisor. That way, you can keep the most money in taxes. The second thing that you want to do is you want to create a financial system with your money or give a job to every dollar that you earn. But now when it comes to giving a job to every dollar that you earn, the key thing that you have to understand is that some of the money that you earn is going to be used for your spending. Some of the money that you earn has to be used for your investments, and some of the money that you earn should be put aside for your savings. Now, the reason why this is so important is because most people earn money to spend money. Most Americans are working to spend money to buy a faster car. Most Americans are working to earn money to spend their money on a new vacation. Most Americans are working to earn money to spend their money at Gucci. Now, while that's nice, the reality is that's never going to make you wealthy, period. What wealthy people are doing, and people who aspire to become wealthy are doing, is the first thing they do is they understand, I cannot spend all my money. If I earn $1,000 after taxes, I cannot spend all this money because then you have no money to actually build any wealth. And then the next thing that people think is, well, okay, if I want to build wealth, I earn $1,000 after taxes, I'll spend most of it and I'll save the rest. I'll save $100 out of my $1,000, I'll spend the other $900 and I'm good. Well, I hate to break it to you, but you will never, ever, ever be able to become wealthy by saving your money. This dynamic of saving your way to wealth does not work in today's economic climate. Maybe it worked for your parents or your grandparents, but it does not work today because of inflation. Your savings are not growing fast enough to keep up with the rising cost of living. So now, what do you do to combat that? You have to invest your money. Now, this can become scary, especially if you didn't grow up in a household talking about investing or financial education, because when you hear the topic of investing, you think risk. What if I lose my money? What if the stock market crashes? What if something happens to the real estate market? What if the economy goes down? I could lose half of my money overnight. Well, yes, that is a risk, but there's also a risk of you not investing your money. Because if you don't invest your money, well, not only are your savings going to lose value to inflation, which is a guaranteed loss, but the money you spend is a guaranteed loss as well. Because when you take that $1,000 and you spend $900 of it at Gucci, at Lululemon, at Chipotle, all $900 of those dollars are gone and you're never going to have a chance to see any of that money again. And this is where what wealthy people want to do is they want to emphasize this. They want to invest their money aggressively because this is what's going to allow you to build wealth. Now, I'll talk about the different ways that you can invest your money in part number 3, but this is where now you have to give a job to every dollar that you earn. And one of the things that I like to do is create 3 different bank accounts. Have a bank account for your spending money, have a bank account for your investing money, and have a separate bank account for your savings money. And the reason why you want to create 3 different bank accounts is so you accidentally do not spend your investment money. Because when it's in 3 different bank accounts, you're going to look at that money very differently. If you only see $650 in this account, and you go into that store and you see the $1,000 phone that you cannot finance, well, now you're going to realize, oh, I don't have the money to buy that phone. And it's going to make you think twice as opposed to if you had all the money in one account. So the simplest thing that you can do is go to your bank, create 3 different bank accounts, and then you can create an automatic withdrawal and deposit, which says that now every time I get paid, some of this money is going to go into this bank account for my investing money, and some of this money is going to go into my savings account, which holds my savings money. Now you can find the right percentage that works for you. One of the things that I like to say is something like a 75, 15, 10 plan to start, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend, 15 cents is the minimum that you should be investing, and 10 cents is the minimum that you're saving. Now, when it comes to your savings, there is a cap to how much you should save, and that cap is going to depend on really your financial situation, because your savings are not there to make you wealthy. Your savings are there to protect you against a financial emergency. Your savings are there to protect you in case your car breaks down, in case your window breaks, in case your kid's arm breaks. That's why you want to have savings, that way you have some cash to fall back on, so you don't have to go into credit card debt when life happens, because let me tell you something, life happens. That's why it's called life. So how much savings should you have? Well, somewhere between 3 months and 12 months worth of expenses, depending on where you are in life. If you're 24 years old, you don't really got any financial expenses or liabilities, and you're open to taking on a whole bunch of risk, you don't need a year's worth of expenses saved up. Be more aggressive with your investments. You got time on your side. Maybe you only need a few months worth of savings. Now, if you're 45, 48 years old, you got kids you have to save up for, you have a spouse to take care of, you got other financial liabilities you want to take care of, now it makes sense for you to have 6 months, maybe 9 months, maybe a year's worth of expenses, depending on where your risk tolerance is. If you don't really have a very high risk tolerance, then you can have a bigger savings cushion. If you have a higher risk tolerance, then maybe all you need is 6 months. But this is where you have to kind of think about how much money do you want to save. Once you hit that savings goal, then what I want you to do is take this 10% that you're saving and put that money here into your investments. That way now, instead of investing 15%, you're investing 25% of your income because, well, you've already built the savings cushion. More savings is not going to do you any more good. So take this money, put it into your investments. Now you can invest more aggressively. But now what you're doing is you've assigned a job to every dollar that you earn, and your money is automatically being transferred. So you built a system for your money, and now you know I cannot spend my investment money because this is the money that's going to make me rich. This is the money that's going to make me look rich. Most people focus on looking rich more than they do on actually getting rich, and that's why most Americans are product rich but investment poor. But if you really want to become wealthy, you got to become investment rich, and well, I guess you don't have to be product poor, but if you sacrifice some of this, well, that's going to allow you to become wealthy here. It's kind of the ironic thing that the people that look the richest oftentimes don't have the assets to show for it, but the people who have all the assets, they don't feel the need to show it off the way that somebody who doesn't have the assets needs to. Now, whether or not you want to buy the Gucci, Louis Vuitton, I'm going to leave that up to you, but the key is I want you to own the assets first. Once you understand this is where you have to understand number 3, how do you grow your money? How do you invest your money? How do you build that wealth? Now, this is where things really start to get fun, because when we talk about growing your money, the whole idea here is you're now putting your money to work. That way it can work and generate you money even when you're not working. And this is where real financial education comes into play. And if you do like learning more about this type of stuff, I do want to let you know that we have a free ebook on how to build wealth as an investor, even if you don't have any experience as an investor. This is an ebook written by my company, Briefs Media. It's completely free. I got the link for you down in the description below. But it walks you through how do you build a financial system, how do you build a wealthy mindset, how do you save your first couple $1,000s, how do you start generating cash flow from your investments, different investment ideas, and just kind of walks you through step by step different things that you can do to start investing your money, building your wealth, and potentially generating cash flow, depending on how you want to invest your money. So if you want to read this ebook, it's completely free, and I got it for you down in the description. Now, the whole idea behind growing your money is you're taking the money that you put aside towards your investments, and you're going to use this money in the most strategic way possible. That way this money starts to grow and could potentially create a new income stream for you without you having to work. But there's a couple things I want you to understand about this. Number 1 is let's talk about some ideal returns when it comes to investing your money. Because when it comes to investing your money, you have a lot of people on the internet talking about, oh, throw your money into this investment and get a 200% return. And well, that sounds exciting. It's not sustainable. And while some people could get that 1 year, maybe 2 years, maybe 3 years, it's not sustainable. And the fast money is also the fastest money to go away. And so if we talk about sustainable returns, generally what you have seen in the past from the historical stock market returns is that the stock market and the real estate market generally grow by an average of 7 to 10% a year. This is what we have seen over the last century. Now, does this mean that the stock market and real estate market always grow by 7 to 10%? No. This is an average. That means some years it grows more, some years it grows less, some years you see losses. We have seen market crashes. We've seen real estate crashes. This has happened many times over the last century. But after factoring in the crashes, after factoring the big boom years, this is what we have seen as the average. So when you understand this, I also want you to play this against debt. Because if you have any sort of high interest debt, maybe you have credit card debt, and if that credit card debt is costing you, let's just say 18% a year, well, now let's think about this. Your credit card debt is costing you 18% a year. When you go and invest your money, you're trying to get a 7 to 10% a year. Which number is bigger? Now, you might be wondering, why am I saying it like this? Well, because I have seen many people with 18 to 28% credit card debts that are asking, how should I be investing the rest of my money in the stock market? And this is where I want you to understand, you're trying to get a 7 to 10% return in your stock market portfolio or real estate portfolio. But if you're paying 18% on your credit card, it makes more sense for you to take your investment money and work to pay down your high interest debt first. Because if you can stop paying your credit card debt 1 year early, that is a guaranteed 18% return on your money. Now, if you take the same money and you put it into the stock market, you might be able to get a 7% return. You might be able to get a 10% return. You might be able to get an 18% return, but you might also lose money. So now you have risk here. You could make less. You could make the same. You could make more, but it's risky. This is guaranteed. So if you have high interest debts, one of the things that I always like to say is pay down your high interest debts, your credit card debts, before you go out and start talking about how do you invest your money in stocks and real estate. Now, the next question everybody has is, well, where should I put my money? Should I put it in stocks? Should I put it in real estate? Should I put it in ETF? Should I put it in index funds? Should I put it in mutual funds? Should I put it in individual companies? And this is where you can really get overwhelmed with the amount of options that are out there. Because now you might see the next hot stock, you might hear about Tesla on the news, you might hear about Apple on the news, you might hear about this brand new mutual fund on the news. And the reason why many people don't become wealthy isn't because they picked the wrong stock, or it's not because they picked the wrong mutual fund, or it's not because they picked the fund with the wrong expense ratio. It's because they never got started. Now, of course, there's a con to picking the wrong investment. However, the key to building long-term wealth is getting started. Because even if you pick the wrong investment, at least you're getting started. And what happens, even if you make the wrong investment, is you are starting to learn. Losing is a part of the process, which you'll see in pretty much every one of my disclaimers, is you're virtually guaranteed to lose money. Every single successful investor in the history of time has lost money. And if you're really scared about losing money, well, then you're never going to get started. And if you never get started, you're never going to see the success. But in order to get the success, you got to get started, and you have to be willing to lose money, because unfortunately, losing is a part of the process. However, the goal is to make way more than you lose. Because when you have skin in the game, when you actually start investing your money, you're going to be much more willing to learn. And this video can go on for hours talking about how to analyze a stock, talking about how to analyze a real estate investment, and we go over that in the ebook. But what I want you to understand is the first thing you got to do is just get started. You don't got to throw your entire investment portfolio into one thing, but you have to get started. Start with $10. Start with $100. Start with something you're very comfortable with losing. Understand that when you invest that money, you could lose all of it. So don't go and just dump your entire life savings into an investment, but get started slowly, dip your toes in the water, and then start learning. Because then what you're going to realize is maybe you hate the stock market, maybe you hate analyzing individual companies, and you just want to throw your money into an S&P 500 ETF, meaning you just want to invest your money into a fund that's giving you exposure to the largest 500 companies in the stock market. Now, you don't have to worry about analyzing companies. You don't have to worry about trying to time the markets. You just put a little bit of money in every week, and now you set it on autopilot and don't have to worry about it. Maybe you realize, oh yeah, I like analyzing companies. I like listening to earnings calls. I like studying financial statements. I like looking at the balance sheet. I like looking at the income statement. I like valuing a company. And I'm actually pretty good at it. So maybe now you don't invest in these funds. You're looking for individual companies. Maybe you say, I hate stocks. I like investing in real estate. I like being involved. I like working with tenants. I like working with management companies. I like building systems and processes. And so maybe you'll go into real estate. But you gotta get started, because if you don't start, you're not gonna know what you like, you're not gonna know what you're good at, and you're not gonna know what you wanna do. Because the same investing strategy is not gonna work for everybody. Some people are going to work better in the stock market. Some people are going to work better with passive investments like ETFs and index funds and mutual funds. Some people are going to work better with individual stocks. Some people are going to work better by investing in real estate. Some people are going to work better by investing in startup companies. But in order for you to figure it out, you have to get started. And the way for you to get started is by, number one, not spending all of your money and having money to invest. If you want to manage your money like the top 1%, there are 5.5 things that you need to do. And if you stick with me until the end of the video, you're going to know exactly how to do that. I'll show you. Number one, you have to build a foundation for your finances. I'll explain what that means. Number two, you have to build an investing system. This is where your wealth is going to be built through your investments. Number three, you have to build a conscientious spending plan with the money that you're generating. Number four, you have to figure out how you can grow your income strategically. Then number five, you have to figure out how to protect your assets. Every wealthy person puts a lot of emphasis here on their asset protection, because as you make more money, people are going to want to take some of the money for themselves. And then number 5.5 is you have to have the right mindset, because even if you have all the financial education, if you have a broke mindset, it is going to be impossible for you to become wealthy. So let's dig in by starting by talking about number one, laying the foundation for your finances. The majority of Americans statistically do not have $1,000 saved up to protect them against an emergency. So what happens for the majority of people when you run into an issue like your car breaks down, your window breaks, your kid breaks their arm? The majority of Americans have to then turn to credit card debt, which is why credit card debt has become such a big problem in the United States. And this is where, if you want to be able to break out of this mess, of this system of constantly relying on your next paycheck to make yesterday's bills, what you need to do is start by laying the foundation. And I know this one's a little bit difficult because everybody wants to start by just investing their money. How do I build my wealth? Well, you can't do that unless you lay the foundation first. If you wanted to build a home, what would you do? You got to first dig the foundation. If you wanted to build a tower, what would you do? You got to dig a deeper foundation. So if you want to build your wealth up. You have to start by going down and lay that foundation for your finances. And what I want you to do here is first I want you to go out and save $2,000 as fast as possible. And then once you save that $2,000, I then want you to go out and pay off your high interest debts. That means things like your credit card debts and your payday loans. And the reason why I want you to do it in this order, get the $2,000 first and then pay down the high interest debts aggressively, is because if you pay down or you're working to pay down those high interest debts and then something happens, your car doesn't work or your AC stops working, what's going to happen? You're working to pay down the debt, but then you find out your AC stops working and then you have to pay somebody to fix that with money you don't have, which means you end up deeper in debt. And that's why I want you to first work on aggressively working to save $2,000 as fast as possible. The reason why you need to do this is because if you don't have $2,000 saved up, you're in what I call financial danger zone. So I want you to be extremely aggressive on this. That means no eating out of restaurants, no spending money on anything that you don't need in order to survive until you got the $2,000 saved up. Now, when you got this $2,000 saved up, what I want you to remember is this $2,000 is not money you're going to go out and shop with. It's not money you're going to go out and invest with. It's not money you're going to go out and spend. This is $2,000 sitting there to protect you against something going wrong, against life's emergencies. Think of it like your rainy day fund, your emergency fund, whatever you want to call it. This $2,000 is money you have to put aside because the reality is life happens to everybody. And if you don't have some cash put aside, you're going to be the one that's going deeper into debt to solve that problem. Once you got the $2,000 put aside, now I want you to stop saving more money, and then I want you to take every additional dollar that you earn and aggressively pay down your high interest debts, your credit card debts, your payday loans, your whatever 0% APR loans that you didn't pay off in time. These are the things that I need you to pay off ASAP, because when you're paying 15, 20, 25, 30% in interest to your lender to borrow money, you will never have the ability to ever build wealth. When you invest your money into something like the stock market, you're trying to get a 7 to 10% return. That's the average historical stock market return. Well, if you're trying to grow your money by 7 to 10%, but then you have to pay 20 to 30% to your lender, it doesn't make sense for you to invest because all of your money is going to make your lender rich. And this is where you have to stop making your banker and your lender rich. And this means you got to pay down the credit card debt as fast as possible. Now, there's a lot of different strategies that you can follow to pay down the credit card debt. You could follow the debt avalanche method, the debt snowball method. The debt avalanche method means that you're going to pay down the debts in order from the highest interest rate to the lowest interest rate. The debt snowball says that you're going to pay down the smallest debt balance first, and then you're going to slowly work your way up to the larger debt balances. I don't care which one you follow. All I want you to do is get aggressive in paying down these high interest debts as fast as possible, because these debts are what is keeping you back from ever being able to build wealth, because now anytime you make money, your money is going directly to the banker, is going directly to the lender, and you're never going to have a chance to build upwards until you lay this foundation. So you got to figure out now, how can you save the first couple $1,000s and pay down this credit card debt as fast as possible? That might mean no more spending money. That might mean you got to sell your stuff. That might mean you have to sell your car. That might mean you have to sell your apartment or move out of your apartment or move out of your home and downsize. That might mean you have to sell your furniture. That might mean you have to sacrifice going on the vacation. That might mean you have to say no to going to that wedding. That might mean you have to say no to going to that bachelor party. There are sacrifices required to doing this. It is not going to be easy. You didn't watch this video thinking that it was going to be easy, did you? Maybe you did, but it's not going to be easy. It takes financial sacrifice because, while everybody on the internet is going to talk about how I can make $1 million without putting in any effort, the reality is that doesn't work. You have to be willing to make the sacrifice and put in the work. And the first thing you got to do is build that foundation, which is bringing us to number 2, which is now building an investing system for your money. What every single wealthy person does well is to pay themselves before they pay everybody else. And what that means isn't that you're going to go to the Gucci store and buy yourself something nice before you go out and buy things for other people. What that means is you are going to invest this money to make you more money before you go out and spend all your money on things that lose you money. And in order for you to do that, what wealthy people do, and what I want you to do, is they create a system. They give jobs to every dollar that they earn. They know now, if I generate $1,000, how much of this money am I allowed to spend? how much of this money do I have to invest, and how much of this money do I have to save. They build a system like this, that way no matter how much money they earn, they're always investing some of their money, they're always saving some of their money, and they're spending whatever's left. The majority of Americans, what they do is they make money, they spend their money, and then if there's any money left over, then they might save it or they might invest some of it. But you want to flip this. And this is where you have to create a strict system. And this is difficult, especially when you're struggling with your money, because you might feel like, if I'm already struggling paying my bills, how in the world now do you expect me to start investing my money? How in the world do you expect me to start saving some of my money? I'm already living paycheck to paycheck. And this is where the way I want you to think of it is, if tomorrow the United States government imposed a brand new tax on you, what would you do? You might kick, scream, complain, cry, but eventually you're going to figure out a way to pay it because you're going to have no other option, because if you don't pay your taxes, you're going to end up in jail. Well, this is where you got to do the same thing. I want you to tax yourself. But instead of giving your money to the government now, you're using your money to make yourself richer. And this is where you can create a financial system that works for you. One of the things that I like to talk about is a 75-15-10 plan. This is a very simple way to start, and you can adjust this to whatever works better for you. But 75-15-10 says that for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. And the best way for you to do this is to go to your bank, create 3 different bank accounts. And you want to create 3 different bank accounts because if you keep all this money in one bank account, well, it's going to be very hard for you to know how much of this money you're supposed to invest or save or spend. So I want you to create 3 different bank accounts and then create automatic withdrawals. That way now, when you get paid, some of your money will automatically be pulled out of that first bank account and be put into a second bank account, which holds your investing money. And some of this money will automatically be pulled out of this first bank account and be put in your third bank account, which is your savings money. Now, you can't spend this money or this money because it's not in your spending account. And now when you don't see the money, you're going to be less tempted to spend it because this money can be automatically invested. This money can be automatically saved. And now the question is, well, what do you actually do to grow your money and build your wealth? Now, when it comes to savings, let me just start by talking about that. Because your savings are not there to make you wealthy. Now, I know a lot of us growing up thinking that you need to save your money, build as much of a savings cushion as possible because that's what's going to make you wealthy and secure. Your savings are not there to make you wealthy. Your savings are there to protect you against an emergency, period. Because the reality is, when you have high inflation, your savings get eaten away by inflation. And this is where now understanding that inflation has been around for a long time and it's going to continue to be around for as long as we can foresee, you want to save money to protect you, but not rely on your cash to be there to build wealth. That's what your investments are for. So when you save your money, you want to have somewhere between 3 to 12 months worth of expenses saved. And I know it's a big range, but it's going to depend on where you are in your financial situation. If you're 45 years old, you got a spouse, you got kids, you got other financial responsibilities, you got to take care of your parents, and you don't have a very high risk tolerance, maybe you need 6, 9, or 12 months worth of savings put aside to make you feel a little bit more secure. If you're 23 years old, you got your first job, you have no financial commitments, no financial responsibilities, you don't need to worry about having 6, 9, or 12 months worth of savings put aside. You can be a lot more aggressive right now because you're young. Now maybe you only need 3 to 4 months of savings put aside because now you can be even more aggressive with your investments. So the amount of money you save is going to kind of vary depending on where you are in your financial situation, in your life situation, but you have to keep working on building these investments because this is where your wealth is going to be built. Now, there are a couple ways for you to invest your money. This money can be automatically invested, or this money can be more manually invested. Like if you're investing into something like a 401k or an IRA, you might have automatic contributions. That can be a part of this, but I don't want you to solely rely on your 401k to retire or become financially free, because what's going to happen for the majority of Americans is the majority of Americans are going to hit retirement and realize that the 401k wasn't enough. In fact, the founder of the 401k has even come out and said that the 401k has gone awry because so many people are relying just on the 401k to retire financially free. I do not want you to do that. So you can have automatic contributions to things like your 401k or IRA, but that's not enough. I also want you to continue investing your money on your own. Now, when you're investing your money on your own, again, this could be automatic or this can be non-automatic, manual. And that is going to be a little bit more up to you on what is the right type of financial investment for you. If you want to just passively invest this money, automatically invest this money, that means now this money is going to be automatically pulled out and invested into your portfolio of stocks, ETFs, index funds, maybe it's real estate crowdfunded deals, whatever it might be. You might not even need a separate bank account for investment money because this money can be pulled directly out of this account and automatically invested. Or maybe you think, I want to be more involved. I want to find startups to invest in. I want to invest in businesses. I want to invest in stocks. I want to go out and invest in real estate. Well, now in order to do that, you might need more cash put aside, in which case now you can start building and accumulating a cash pile here that would now, when you find a good investment opportunity, you have the cash to go out and invest. But the key is you have money to be invested. The way that you invest your money is going to vary based on your investing strategy. And there are so many different investing strategies. Like I invest my money passively, I invest my money actively, I invest my money in real estate, I invest my money into individual stocks, I invest my money into ETFs, I invest my money into startups, I invest my money into my own business. So there's a lot of ways that you can invest your money, and I'm not here to tell you, you got to invest your money this way, because what works for you might not work for me. But the key is that you have to have this money being put to work to invest, because this is what's going to make you wealthy. Now, I'm not going to do a full deep dive of all the different ways that you can invest your money in this video, because that would make this video very, very, very long. So if you want to learn more, my team at Briefs Media put together this amazing ebook on how to build wealth as an investor that you can read for free. And this ebook starts with the basics of, well, how do you build the mindset of an investor, to understanding the economic system, to then what are the different ways that you can invest your money, how do you invest for cash flow, how do you invest your money other ways, and then how do you spend your money smartly, how do you earn more money, and how do you protect your assets. Kind of like what we're talking about in this video. So if you want to read this ebook, it is completely free. All you got to do is click the link down in the description below. The last thing that I'm going to say about your investments before I move on to here is there's a couple of different ways that you can get paid with your investments. You can get paid with cash flow, or you can get paid with appreciation, meaning I bought a stock for $100 and now it's worth $200, and now I can sell the stock and make a $100 profit. The majority of my investments are cash flow investments, meaning the majority of my investments, not all of them, but the majority of them are paying me with some sort of cash flow, because I like cash flow. And the reason why I like cash flow is because when I have cash flow, I can get paid without having to sell my assets. So as you think about now you investing your money, I also want you to think about, how do you want to get paid? Do you want to get paid more with cash flow, or would you rather see more of that appreciation and see more of a growth of the value of your investments? Neither of them are bad. You just got to figure out what's right for you. This brings me now to the third point here, which is, what do you do with this money that you spend? Which brings me to number 3, spending your money smartly. There's a running joke that I make when it comes to spending, which is that American people make $1 to spend $2, while Indian people make $1 to spend 20 cents. And the reason why is because the cultures are very different and the mindsets around money are very different. An Indian person, a traditional Indian mindset person, I can tell you this from experience because I grew up in a very traditional Indian house, you work to earn money to save as much money as possible. You will make $100,000 so you can live off of $30,000 a year and then save all that other money. But what you see happen with a lot of Americans, yes, I know I'm generalizing. If you're offended, you can leave this video. With a lot of Americans, you make money. That way you can finance it and spend even more with credit card debt and other forms of credit. And this is where now neither of them are right, but you want to understand how to spend your money smartly. And what this means now is it is very easy to buy things, especially in America. You can buy things with credit cards. You can buy things with lines of credit. You can buy things with buy now, pay later, or as I like to call it, broke now, broke later. But the key is there's a difference to being able to afford something and being able to buy something. See, when most people think about being able to afford a new phone, they think, oh, I can make the $50 payments. But you're not actually affording the phone. You are buying the phone. And so what I want you to do is start reframing that question of, what does it mean to actually afford something? And the first thing that I want you to understand and remember is, if this thing does not put money in your pocket, you should not be financing it, period. The only exception to this would be your house. Even when it comes to your car, I don't like financing cars. I do not recommend financing cars. Now, I'm not a financial advisor. I can't recommend anything. However, financing cars means you're paying interest to drive around in a car that's losing value. Now, if you're making a ton of money, if you're very wealthy and you want to lease a car because you just don't want to have to deal with the maintenance and you want to keep flipping cars, fine. But you got to understand that when you're leasing a car, it's kind of like flying first class. You can get to the same place by flying economy. You're paying for that extra luxury. So if you can afford that extra luxury, fine. It's the same thing with leasing a car. When you're leasing a car, you're paying for that extra luxury. Anything wrong with that? No, but you're buying a luxury. You got to make sure you can afford that luxury. And if you're struggling with money, if you don't have any cash flow coming in, you don't got your dividends coming in, you don't have that financial foundation built, you should not be financing or leasing cars. And this is where right now I want you to go back to what does it mean to buy something versus being able to afford something. And a simple rule of thumb that you can follow, which I know is hard, especially when it comes to things that you don't need to survive, is to follow my rule of 5, which says if you cannot buy 5 of them, you cannot afford 1 of them. Now, this means if you want to go out and buy that same $1,000 phone, making the $50 a month payment does not mean you can afford it. If you want to be able to afford that $1,000 phone, that means you have to have the cash in the bank in your spending account to be able to buy 5 of them. You have to have $5,000 to go out and buy that $1,000 phone, and that means some of you might have to downgrade some of your purchases. Maybe that means you don't always buy the newest iPhone. Maybe that means you don't always buy the brand new Lululemon pants. Maybe that means you don't buy all that Gucci, and you got to downgrade a little bit, which is difficult. But when you do that, you're going to have more money here, which can give you more money to spend here, and this means you can make even more wealth. And this is where, it helps for you to kind of remember the difference between a want and a need. Because now you might be saying, but Jaspreet, what do you want me to do? I have to get to and from work. I need a car. Yeah, you need a car. You just want the BMW. You need clothes. You just want the Gucci. And this is where there's a difference between what you want and what you need. And this is what gets very difficult because that means you might have to sacrifice a little bit of the lifestyle. Now, I don't want you to permanently sacrifice it. The whole point of being financially smart isn't so you never enjoy your money. It isn't so you can never buy the nice things that you want. It's so you can afford the nice things that you want without having to worry about money, without having to worry about the cost. But in order for you to get there, that requires you to make a sacrifice today. That way you can actually have the nice things and never have to worry about money. And if you make the sacrifice, what will be funny is you're gonna have to go through this kind of little slump where everybody around you has all the nice things, they're bragging about how much money they have. They see you not having the nice stuff and they're gonna be kind of wondering what the heck happened to your finances, what happened to your household. And then a few years later, you'll see things start to flip. You'll see them struggling or talking about how much their bills are difficult and how they're struggling making their payments. And then you go out and start buying the nice things and you don't have to worry about the price. Now, all of a sudden, you went from being the person that everybody wondered what the heck was wrong with them to being the person that people are coming to for financial advice. But that requires you to make that sacrifice and put in the hard work that most people are not willing to do. The 4th step to managing your money like the top 1% is now focusing on income growth. See, if you ask the majority of people today, what is stopping them or what's causing their financial issues? Every single one of them would say, I'm not making enough money. But what we have seen happen statistically is when the majority of Americans make the extra $10,000, they go out and spend that $10,000. Actually, they go out and spend an additional $13,000 because now when you make the 10 grand, you can qualify for more credit on your credit card. You can qualify for bigger lines of credit. You can qualify for more money from the bank. And so people now make an extra 10 grand a year, but then they spend an additional $13,000 a year. Because now as you make more money, you got to go on a nicer vacation, you got to drive a nicer car, maybe you got to upgrade that apartment or your home, you got to have the nicer appliances. And so now you make more money, but you end up in a deeper financial hole. That's why parts number 1, 2, and 3 were all about now money management. Number 4 is about money growth. And this is where now understanding that once you have this financial system working, you know how to save your money. Once you save your money, you invest this money right here. You know how to invest your money. Maybe you're generating cash flow. Maybe you're generating the appreciation. But you know you're always putting your money to work. You're investing your money before you pay yourself. And then you spend whatever's left. And now you realize, I just want to put some more fuel on this fire, baby. And now you got to figure out how you can grow your income. And this can be maybe a career change. Maybe this can be working harder in your job. Maybe this can be a promotion. Maybe this can be getting a second job. Maybe this can mean working on a completely new industry, figuring out a whole new job, a whole new thing that you can do. Or maybe this means starting a side hustle. Maybe this means starting a business. Now, if you talk about what do the 0.1% of people do or the 0.01% of Americans do, how do you build that much wealth? Well, now you're going to have to work to build your own business, because when you invest your money, what you're doing is you are growing the money that you have. And the reality is, if you're making $50,000 a year, $100,000 a year, $500,000 a year, you can make a few $1,000,000 and you can build millions of dollars worth of wealth and retire very financially free. But if you want to fly in private jets, if you want to have that very exotic lifestyle, you have to have way more money working for you. And the way that you can attract and accumulate that way more money is you're going to have to go out and take more risk. And in America, the number one way that has built more wealth than anything else is by going out and starting a business. Now, building a business is hard, it's risky and all that stuff. I'm not going over that in this video. However, what the 0.1% and the 0.01% do is all of them are business owners to some extent or capacity. Maybe their business is investing in businesses. Maybe their business is starting a business. Maybe their business is some sort of real estate development or investment. But you have to have some sort of business involvement if you want to get to that level. However, in any case, even to be part of the 1% now, it's all about now how do you grow your income? That way you can have more money to invest. And this can be a whole slew of opportunities, whatever you feel is right for you, but now you're working to earn more money smartly. That way you have more money to make you actually wealthier instead of just to drive a faster car. Number 5 is, as you start building your wealth, you also want to start investing in advisors that can help you protect your assets. Because as people realize that you have money, they're going to try to take their hands, put it in your pockets, and take some of that for themselves as well. I'll give you a quick example. Earlier in this video, I told you that I invest in real estate. Now, while that's true, it's not exactly true. Let me explain why. Let me diagram this person with a nice mustache as me. And let's say this is a rental property that I own. Well, this property that I own is not actually owned by Jaspreet Singh. I actually own 0 rental properties. They're just not under my name. And what that means is now this property isn't owned by Jaspreet Singh. Instead, it might be owned by an LLC. An LLC is a type of entity. It's a type of company that you can create. It's just a legal term. Your attorneys can help you with this. But now this property is owned by an entity. Let's just call it Jaspreet Singh LLC. Jaspreet Singh doesn't own any real estate. Jaspreet Singh LLC does. Now, Jaspreet Singh owns Jaspreet Singh LLC, but Jaspreet Singh LLC owns this property. And the reason why this is important is because now let's assume that there's a tenant living in this property. They slip and fall, and they sue the company for $5 million. Now, again, they can't sue me because I don't own the property. I just own the company. So they sue the company for $5 million. Let's assume this property is worth $200,000. Now, worst case scenario, insurance doesn't cover the claim. And then the judge says, well, this company, you were entitled to pay the tenant $5 million. Well, if the only thing that this LLC owns is this property and it's worth $200,000, you declare bankruptcy, the tenant gets the property. So the max they're entitled to is whatever is in this LLC. They cannot come after my personal assets, assuming I treat this LLC as its own business. I'm not using the LLC money to pay for my groceries directly. I have my LLC bank account and I have my personal bank account. If I treat this like a real business, that means the most that the tenant can take out of this LLC is whatever's in the LLC. And this is just one form of protection that you can have. And as you start to invest your money, as you start to build your assets, what you're going to want to do is build layers of protection, because the reality is America is the most litigious country in the world. How do I know that? Well, I am a licensed attorney. So I can tell you from a little bit of experience that America loves lawsuits. Anybody can sue anybody for anything. And, well, lawsuits are expensive, so you want to protect yourself. And one way to do that is to have things like LLCs in place. Now, it might not be an LLC for you. I can't recommend what you need because I don't know what your financial situation is. So this is where you want to have the right advisors. That means attorneys. That means tax advisors. That means estate planning attorneys. You want to have the right people on your team that can protect you and guide you, especially as you start building your wealth. And I know nobody likes paying for attorneys. Nobody likes paying for tax accountants. But these things, while they cost you a little bit of money today, they can save you a whole lot of money and a whole lot of headache in the long term. And as you start to build more wealth, you want to make sure you invest more money here as well. And then we have point 5.5, which is your mindset. And the reason why I always like to talk about this is because a lot of us, myself included, did not grow up with financial education. I grew up with a very negative attitude towards money and this whole idea of building wealth, because in my household, it was this thing that like was taboo and bad, that rich people are bad and you shouldn't think about money that way. But at the same time, I saw how hard my parents were working to generate money. So it just didn't make sense to me. We're talking about how bad money is, yet you're going to work every single day to get money. You don't get breaks, you don't get days off. It doesn't make sense, because if you had money, you could take vacations, you could take days off. You wouldn't have to stress so much about money. And that's where I started to think a little bit different about money. And I started to realize that money is just paper. It's just fuel. It amplifies who you are. You give a good person money, they have a tool to do more good. You give a bad person money, they have a tool to do more bad. And this is why we need more good people with money. And that means, number one, you have to change the way that you look at money, but then also change the way that you think about wealth. Because if you don't grow up with wealth, it's very easy to create this negative connotation towards wealth, because it's never something you've been exposed to. So it's, oh, it's that thing. It's those people's thing. It's this greedy, slimy person thing. It's this bad person thing, because it's not something that you were associated with. But if you constantly have this negative connotation and attitude towards wealth and wealthy people, you're not going to want to actually achieve that yourself, because we don't want ourselves to go out and be bad people, right? Like, you don't try to go out and do bad things. You try to do what you think is good. And so if you think becoming wealthy is bad, even if you kind of subconsciously think that, you're going to change the way that you think, you're going to change what you do, and you're going to change what you receive. And so if you want to now actually become wealthy, you can't have such a negative attitude towards wealthy people and wealthy things. You have to start asking the question of, how did they become wealthy? And how can I become wealthy? And what do I need to do to achieve that wealth myself? Because when you start asking, how do I become wealthy, as opposed to, oh my God, they're wealthy, that's bad, now you start asking the right questions. And now you start opening up the way you think. And you start opening up where you learn. And you start opening what you do. And that also starts changing what you receive. And this is where I want you to start working on your mindset. And this is, there's a ton of content on YouTube and podcasts you can listen to. Start with some personal development, education on how you can change the way you think. And even if you feel like you've never had this bad attitude towards money, if you've never really invested in your personal development or that kind of mindset education, just spend a little bit of time learning about it and see if you can start priming yourself to think a little bit bigger, to think a little bit wealthier, to think a little bit more abundantly. Because that's just going to help you achieve more. Because I'm not all about saying, oh, all you got to do is sit there, think positively, and everything's going to come to you. That's not what I'm trying to say. But you have to have this kind of positive attitude towards money if you want to achieve it yourself, because you got to know what to do practically, but you have to have the mindset that's going to allow you to actually achieve it. Every single person wants to be a millionaire, but most people don't know where to start or what to do. And then we start to create these smoke screens, these excuses as to why we can't do it. We say, oh, I don't make enough money. Oh, I wasn't talented enough. Oh, I didn't have this God-given gift. Oh, I'm not one of those people that have a trust fund, or these parents that were rich that gave their kids everything. I don't have the things or what it takes to become a millionaire because I wasn't fortunate enough to be given these things. Well, let me be honest with you for a second. Having all these fancy things, having rich parents, having a trust fund, having a fancy degree, having a big salary, all these things can help you become a millionaire or very financially successful, but you don't need these things to become financially successful or a millionaire. Ronald Reed was a janitor and a gas station attendant, and when he retired, he was a millionaire. Not just with $1 million, but he was a multi-millionaire with $8 million. He wasn't given a trust fund. He didn't have all these fancy degrees or these super high-paying jobs. He just knew what to do with the money that he earned. The reason why he was able to accumulate this multi-million-dollar fortune was because of two things: his smart spending habits and his investing habits. That's it. It had nothing to do with the amount of money he made, it had nothing to do with what school or education he had, it had nothing to do with who his parents were. It came down to his spending and his investing. CNBC wrote an article on Ronald Reed talking about how he accumulated his wealth, and the thing that's really interesting about him and his story is he didn't even tell his family that he was wealthy. He was doing this all on the side. He made his money working as a janitor or working as a gas station attendant, and anytime he made some money, he was smart with his money. He spent it smartly and he invested it smartly, and then he just kept doing this. He kept investing his money his entire life, and then when he passed away, that's when his family, his kids, his grandkids, his relatives found out that Ronald Read was a multi-millionaire. His stepson actually gave an interview about Ronald Read's wealth, and it was really interesting because what he said was, quote, he was tremendously surprised to find out that Ronald Read was a multi-millionaire, and he said that, quote, he was a hard worker, but I don't think anybody had an idea that he was a multi-millionaire. That quality of building wealth quietly is so hard nowadays in our culture because we live in this social media culture. Before, it was keeping up with the Joneses because you saw your neighbors get a brand new car, so you wanted to get a brand new car. Your neighbors got a brand new boat, so you wanted to get a brand new boat. Now, it's the social media flex culture where you're following a whole bunch of random people, and all these random people are broke, spending all their money on Louis Vuitton bags and Gucci belts that they can't afford, and they're buying all these nice things, and now you want to keep up. So now you're spending all your money, going into debt just to keep up with all these random people on social media that you don't even know. That way you can get that double tap, that like on Instagram. But all these things are keeping you poor because what you're doing is you're making all these companies around you rich, but you're keeping yourself broke. Going back to this article, let's talk about Read's spending habits, because what it says is Read maintained a frugal lifestyle where he never spent money unless he had to. What his friend said is that Ronald Read drove a second-hand Toyota Yaris, and he used to use safety pins to hold his coat together, and he was the type of person that was cutting down his own firewood when he was 90 years old. Now I want you to imagine this for a second. Imagine that you have a bank account or an investment account with $8 million of cash sitting there, and at the same time you're driving around in a used car. You could go out and buy a $100,000 supercar tomorrow with cash, and you wouldn't even have to worry about the price. It wouldn't even make a dent into your bank account, because spending $100,000 when you have $8 million in your account is kind of like spending $1,200, assuming that you have $100,000 in your account. So for him to go out and ball out and buy a brand new supercar wouldn't even affect him, yet he's still driving a second-hand Toyota. That's dedication and knowing what you want and not spending money on things that you don't need. Now, my goal for you from a financial education perspective is now for you to just save all your money or just invest every single penny that you have. That way you never have the opportunity to buy the nice things and the luxury things that you want. I want you to be able to buy and afford the things that you want. The key word there is afford, because I want you to have all the nice stuff, but you have to be able to afford it first. For Ronald Read, these luxury things didn't matter to him. For him, he wanted just to keep building his wealth. That way he could create generational wealth and give back to the communities and the charities that he wanted to. But he knew what was important to him. And because he wasn't blowing his money in all this fancy stuff, he was able to build up this huge fortune. It kind of goes back to what sacrifice are you willing to make today? Because if you're willing to make that sacrifice today, if you're willing to sacrifice that car and the nice stuff today, that way you can put that money aside and put it to work today, well then this money that you're putting aside will be able to fund all the nice stuff that you want in the future. Ronald Read's neighbor went out to say that if he earned $50, that he would probably invest 40 of it. So he was investing the bulk of what he was making because that was what was important to him. He didn't want to blow all of his money on fancy stuff. He was investing it, and that clearly worked to build his wealth. So now the question is, how in the world do you actually take a janitor salary or a gas station worker salary and turn that into millions and millions of dollars, especially when we're talking about somebody who did this over the last century, because he died at 92 years old in the mid 2010s. It was 2014 when he passed away. So that means he was earning this money in the 1950s to the 2000s, early 2000s, and he took that money and turned that into a multi-million-dollar fortune. How do you do that? Well, according to the article, he is a good stock picker and he had the control to hold onto his stocks for the long haul. So his financial strategy was pretty simple. He would earn money, and this is money he earned as a janitor and a gas station worker. Then when he earned this money, most of it would be invested. And this would be invested into things that he knew and he understood. And so these were stocks that he believed in, and he held onto these stocks for the long term. And we're talking about years, if not decades. And then if anything was left over, this is what he spent. And he spent on things he needed. So he spent little here, that way he could have more money to invest here, because this is what made him wealthy. At this point, I already know what you're thinking. But Jaspreet, what's the point of me dying a millionaire and not being able to enjoy all this money that I would earn? Well, this is where you have to find the right balance for you. For him, Ronald Reed, he didn't really care about these things. So he just continued investing here because all he wanted was that generational wealth to take care of his family, and he wanted to take care of the charities and the communities that mattered to him. So he kept investing here. For you, if you want to have the nice cars, the nice clothes, the nice vacations and all that, there's nothing wrong with that. But first, you got to stop spending all your money on things that you don't need right now. That way you have more money to put here. And once you start building this wealth, then hey, start spending money on the things that you want, because now you can afford it, because now you have the cash to do that. This super complex formula that Ronald Reed followed allowed him that when he died, he gave $1.2 million to his local library, he gave $4.8 million to his local hospital, and he gave a couple $1,000,000 back to his family. So now, if we're analyzing different parts of the strategy, the funnel, he did not earn a lot of money. So if you wanted to improve this funnel, what can you do? Well, one thing you can do is you can earn more money. He was a janitor and he was a gas station attendant. If you want to earn more money, start a side hustle, or you can go get a better job, you can get a promotion, whatever you got to do. Earn some more money. Now you have more money coming into the formula. We already talked about the investments. He invested the bulk of his income, and we talked about where he invested it. You don't have to invest your money in stocks. You can invest your money in real estate and other places, but that's what he did. Then you can also talk about where he spent his money, right? We talked about how you don't want to just be blowing all your money on things right now, because now you want to put this money towards your investments. So there's 3 different parts to this formula. One is earning money. Second is what you do with the money you earn, and how much are you investing, how much are you spending. Financial education really doesn't have to be rocket science. The one key thing that really allowed this process to work though is in this part right here, because not only did he just put his money into the stock market, the thing that allowed him to actually make money and build this wealth in the stock market was he kept his money in the market for years and decades, because that real wealth happens over time. Because when you're investing your money in the stock market, or really any asset class for that matter, but we'll focus on the stock market here. When you're investing your money in the market, what you're trying to do is you're trying to invest in companies that you believe in. And these companies take time to really grow and create new products and develop their revenue and the profit, and then for that price, the new profit, to be shown in the stock price. And so this takes time to happen. And that's what he allowed himself to do by investing his money into the market, consistently doing that, and letting his money compound and grow. Because what happens to a lot of people, especially nowadays, because of these new brokers and this new kind of age where everyone's trying to make 100% returns in a week, what's happening is people want to see these returns almost overnight. We want to get rich quick. I mean, it's natural. Who doesn't want to get rich quick? Who wants to get rich slowly? The reality is, if you want to get rich, one of the most consistent and proven ways to do that is through long-term sustainable investing, and that's exactly what he did. And so what you want to do is you got to believe in these companies, and even when things start to go down, if you believe in your companies, you should not be selling. The only thing that you should be doing is coming in and buying more. Going back to the CNBC article, because there was one more part that I thought was really interesting. He gave $1.2 million to his local library, the Brooks Memorial Hospital. And the interesting thing about what the library did is they didn't just take all this money and spend it in the library. What they did instead was they invested the money. They said they invested the bulk of their money, the donation that they got. That way it will continue to pay dividends and support us down the road. When you go out and you work and you earn money, this money pays you once, because this is now money that you have in your hand, and if you spend that money, this money is gone. But if you take this money and you put it in your investments, and these investments pay you every single year, well, now you have money coming back every single year, and this will continue to happen as long as you own the right investments. And so now you have money to blow every single year, because this is cash flow coming in from your investments. And that's what the library is doing. I'm glad they did that with their money, because now this asset is going to pay them for years into the future, and now this is money that they can use to improve the library for years and years and years. Your salary will never make you wealthy. I don't care how much money you make. I don't care if you're making $500,000 a year or if you're making $20,000 a year. Your salary cannot make you wealthy, because as soon as you stop going to work, your money's gonna stop coming in. And if your money's not coming in, how are you gonna pay your bills? How are you gonna afford your vacations? How are you gonna afford your cars? How are you gonna afford to eat and live your life? Because if you're not working, now you're not getting paid. And sure, maybe you got some savings, but your savings work the same way. Even if you have $1 million in your savings account sitting there, well, every time you spend $1, your savings are gonna shrink and shrink and shrink. And eventually, if you live long enough, and you hope that you live long enough, your savings are just going to dry up and they're going to go away. So you can't outsave your way into wealth. What you need to do if you want to become wealthy is you have to have these investments, because these investments will continue to pay you even when you're not physically working. This money that you're earning from your job, your earned income, has to be invested. You need to be investing as much as possible, because this is what is going to make you wealthy. You cannot become wealthy by earning more money. You cannot become wealthy by spending all your money. The only way you can become wealthy, and when I talk about wealthy, is being able to buy back your time, is if you have investments, because these investments will pay you even when you're not physically working. This is where now you can jump into different investing strategies and different investing goals, and how you can amplify your investments by earning more money and spending less money. But the whole premise of any of this is you have to have the right financial education, which means you have to be investing your money the right way. That way now you're using your money as a tool to make your money, instead of using your money as a tool to make everybody else around you rich. Because when you're spending all your money, you're making everybody else rich, but you're keeping yourself broke. So what am I trying to get at with all of this? Well, if you want to become wealthy, what it comes down to is how you use your money. It is the financial education that you have, more than it is just how much money you earn, what job you have, or anything else. It's what you do with the money you earn. That's why we've said multiple times on this channel that it's not just how much money you make that matters, it's what you do with the money you make. Once you know how to spend your money and invest your money the right way, now if you earn more money, you're going to earn more money in the most valuable way possible, because you'll know how to use this money the right way. Everybody has an opinion on how you should spend, save, and invest your money. But rule number one of investing is stop listening to random people on how to invest your money, including a random guy on YouTube. If you won't trust a fat person with nutrition advice, why would you trust a broke person with financial advice? Plus, your financial goals are your goals. They're not my goals, they're not your uncle's goals, and they're not your broke cousin Bunty's goals. That's why you have to start creating your own financial decisions. Listen to other people, but don't just blindly listen to what other people are doing. Stop copying other people, learn how to invest, and then apply the best information to you instead of just blindly following somebody else. Because even if you blindly follow somebody else, you probably won't see the same returns as them. People try to blindly follow what Warren Buffett's doing, but nobody gets the same returns as Warren Buffett. Number two is remember that what goes up also goes down. No asset class can go straight up forever. Not Bitcoin, not artificial intelligence stocks, not housing, not even tech stocks. By the time you hear about the next big stock in the news, chances are you already missed the big money-making opportunity. Not to mention that our economy moves in cycles. Recessions are a part of our economic system. We saw a recession in 2020. We saw a recession in 2008, 2000, 1991, 1981, 1980, 1973. You get the idea. Recessions happen. Our economy goes up and our economy goes down. And when you start trying to chase an asset class because you see it running up in value, the news is covering it, all of your friends are making money, well, that might be a time where you want to take a step back and just watch what's happening instead of trying to jump in, trying to chase the hype that everybody else is throwing their money into without really understanding what they're buying. If you've watched any of my other videos, you've heard me say that investing has risks. You're never guaranteed to make any money when you invest. In fact, you will probably lose money at some point, because that's what investing is. It is risky. And so now when you go in trying to invest your money, trying to grow your money, you have to understand that there's a chance that you could lose all of your money. There's a chance that your investment could go bankrupt. There's a chance that your investment will go down to zero. If you don't have the financial backbone to potentially lose that money, then you're going to be very stressed trying to understand what's going on in the markets, because investments go up and they go down, and when they go down, you don't want to be the person that's panic selling. Not to mention the fact that if you go out and start investing with debt, whether you're using debt to go out and invest in real estate, whether you're using debt to go out and buy or invest in your business, or whether you're using debt to invest in stocks through margin, debt amplifies risk. I do not recommend any beginner investor to go out and start taking on a whole bunch of debt and start using this money to invest, because the whole pitch of investing with debt, whether it's in the stock market or anywhere else, is debt will allow you to amplify your returns. But the part that you're missing with that is that debt also amplifies your risk. If you take $1,000 and you invest this money into the stock market, the most you can lose is $1,000. But now if you invest $1,000 of your own money, and now you invest $5,000 of your stock brokerage's money with margin, now you can lose way more money than what you're putting in. Yeah, you could double your money and make a whole lot more money, because now you can double $6,000 into $12,000, and most of that money is your profit. But if you lose all that money, now not only did you lose all the money that you put in, but now you owe money to your brokerage. Debt amplifies risk. And if you don't know how to invest your money, or if you're not willing to take that risk, or if you don't understand that risk, do not use debt. And this brings me to rule number 4, which is that more risk comes with more potential return. Now, if you do want to know how to invest your money smartly, my team at Briefs Media put together this amazing ebook titled How to Build Wealth as an Investor. This ebook will walk you through things like how do you build the mindset of an investor, to how do you save your first couple $1,000s, to how do you start investing your money, what are the different ways that you can invest your money, how do you invest for cash flow, how do you spend your money smartly, how do you earn more money smartly, how do you protect your assets. There is a ton of value in this ebook, and you can read this ebook for free. So if you want to download this ebook, I got the link to how you can download this ebook for free down in the description below, or you can go to briefs.co/ebook. If you go and save up $10,000 and you take all 10 grand and you put it into a safe and you lock it, the money is going to be safe, but you're not going to get any return. Low risk, low return. Now, if you take that $10,000 and you throw it into your business idea, that $10,000 could turn into $1 million business idea, maybe even $1 billion business idea, but that $10,000 could also go down to zero. Higher risk, higher potential return. Now, what you have to analyze as an investor is what is the right level of risk. Now, when we talk about investing, I'm talking about taking your money and putting it into some other asset that you don't have to actively monitor and operate. This might be something like managing rental properties, because now you can have a management company that does the work, or putting your money into things like stocks. Now, even within real estate and stocks, there's different levels of risk with the types of investments that you'll invest in. For example, if you go and you invest in stocks, investing in individual companies is riskier than investing in index funds. And now you got to manage your risk and your returns accordingly. Just like that when it comes to real estate, if you're investing in distressed real estate, that comes with more risk than investing in turnkey real estate. Properties that are already renovated, that are already rented out, that's going to be easier to manage because you're already generating the cash flow, versus a property that's beat down, that doesn't have any tenants, that has a whole bunch of problems with the property. That's going to take more risk, but the potential to make more money. Now, are you guaranteed to make more money? No, but higher risk comes with higher potential return. Number 5 is buy the asset, not the hype. The first recorded financial bubble in history was a concept called tulipomania or tulip mania, which happened because investors started buying tulip bulbs, yes, tulip bulbs, not because they wanted to buy the actual flowers, but because they were hoping that they can make a lot of money flipping the contracts to buy and sell these tulip bulbs. So now what you saw happen was tulip prices went through the roof, again, not because people wanted the flowers to plant, but because they thought that this was a way to get rich quick. When you start buying this asset because you want to make money as opposed to owning the underlying asset, that's what builds bubbles, and that's what creates these huge booms and busts. When you go out and invest your money, whether it's in stocks, you have to look at the underlying asset, the underlying company or the underlying companies that you're looking to invest in, as opposed to just seeing the stock price running up. If you see the stock price going up, that's good, or it could be good, but the thing that you want to pay more attention to is what is the underlying asset that you're buying. Because what a lot of people are buying is the hope for this thing to make more money without actually understanding what the thing is that they're buying. And that's the key to actually making real money as an investor, building the long-term security as an investor, is you're buying the asset, not the hype. Rule number 6, trading is not investing. You might have heard people say that it takes money to make money. Well, that's a lie. It takes money to grow your money, but it doesn't take money to actually earn the money. When you're investing your money, what you're doing is you're trying to grow the money that you've already earned. So if you don't have any money to invest, you can't invest your money. Now, you might hear people on the internet talking about how you can invest your money with no money by trying to do this thing like stock trading or flipping real estate. Well, that's not investing. That's trading. Trading is a way for you to earn money. When you're trading, you're spending your time trying to get this income. Now, when you get this income, that's when you can invest it to try to grow this money that you've already built. But investing means you're taking the money that you already have and now you're trying to grow that money. Earning money means you're putting in an effort, you're putting in work to actually generate some money. So when it comes to investing, you need money to invest, but you don't need money to try to earn money. Rule number 7 is that taxes matter. What you want to pay attention to now as an investor is also tax and how that plays a part in your investing portfolio strategy, because one of the biggest expenses for all Americans are taxes. And this is where you understand is how taxes will play a part or eat a part of your investment portfolio. For example, if you are investing your money for dividends, I love investing my money for dividends, you have to understand that taxes also apply to that income. So if you go out and you own an investment portfolio that's paying you, let's just say $10,000 a year in dividend income, well, you can reinvest all $10,000 back into your stocks, so you buy more dividend paying stocks, but you still have to pay taxes on the $10,000 worth of dividend income, even though you might never see that money. Just like that, when it comes to real estate, one of the reasons why real estate investors love investing in real estate is because of taxes. The real estate tax code allows you as an investor to file what's called a depreciation deduction. It is a paper write-off on your taxes that says you deserve a tax break because your property is 1 year older, period. And this allows some investors to make money, to make a profit, to have cash in the bank, and then pay little to no money in taxes legally. That allows you to keep compounding and growing your money without having to pay some of this money in taxes. Because the more money you can invest, well, the more money that you can have growing for you. And this is where now you as an investor want to make sure you understand how taxes are playing a part in your investment portfolio, because if your money is being eaten away by taxes, well, then you might be the one paying the price. Number 8 is you have to know your goal. And this ties into the first thing that I talked about, which is don't just blindly listen to random people. You have your own goal when it comes to investing. For me, my primary goal when I invest my money is generating cash flow. That's why the bulk of my investments are cash flow producing assets. But not all of my investments are for cash flow. I have some investments that are more on the speculative side. Like I invest in some startups. They don't pay me with cash flow, but they're more fun for me. And I also understand the risk, but they're more on the speculative side that hopefully they will be able to grow in value and make me money because maybe some of these startups will get acquired one day. That's the goal with startup investing. And so now when you go out and invest your money, before you just throw your money into the stock market, know how it is you want to get paid. Are you looking for growth? Are you looking for slow and steady growth? Are you looking for fast growth? Or are you looking for cash flow? And if so, how much cash flow? And if so, do you want growing cash flow? And if so, do you want steady cash flow? You have to start asking these questions because, again, risk plays a part with the return that you're going to get. And the type of goals you have are going to determine how you want to get paid. And when you understand this, that can completely change the way that you're going to do your investment analysis, because you want to make sure that you're investing in something that aligns with your goals. What's a good investment for me might not be a good investment for you. And what's a good investment for you might not be a good investment for me. Rule number 9 is understanding that money flows to the patient. Warren Buffett likes to say that the stock market is a device that transfers money from the impatient to the patient. And what that means is you go through these cycles in the economy, but we also go through boom and bust cycles in every single asset class. Stocks, real estate, cryptocurrencies, startups, it doesn't matter what you're talking about. Every asset class goes through these booms and busts. And what happens is when you are in a particular part of the cycle, everybody thinks that this is going to stay forever. When I first started investing in real estate, it was 2011. And I knew nothing about investing. I knew nothing about real estate. I did not have any real estate mentors. I didn't even know that you could invest in real estate. I didn't know anybody that was investing in real estate. I just started investing. But the sentiment at the time was that real estate prices are going to stay low forever. Nobody's going to ever want to own a home, and home prices are going to be depressed for the rest of forever. Well, clearly that didn't stay the case. As real estate prices started to go up, well, then you start to hear the opposite. You hear people talking about how real estate prices can only go up, how real estate prices can't go down, how real estate prices are going to always be high. See the same thing with stocks. When you start to see a boom in any asset class, whether it's artificial intelligence or tech stocks, when things are going up, you hear about how this asset class is going to change the world. It's going to revolutionize things, and this is going to only go up from here. When it's going down, you hear about, oh my God, it was so overvalued. This bubble is over. This asset class is done for. No one's going to ever use this again. I mean, if you remember back to the 2000 dot-com bubble bursting, a lot of people thought that the internet, quote unquote, fad was done for. And because it was done for, people thought that nobody would ever use the internet again. Well, we all know today that's not the case. But this is where there's a lot of emotions when it comes to investing. And your job as an investor is not to get caught up in the emotions, but pay attention to the underlying asset class and invest with financials rather than emotions. And rule number 10 is to remember that failing is a part of the process. The kind of ironic thing about investing is sometimes you could do everything right and still be wrong. And other times you could do everything wrong and still be right and make money. And this is where you have to understand that there's this element of risk when it comes to investing that's sometimes out of your control. Like you could go out and invest in what you think is a great company, a great investment, a great sector, and then a new president comes in and they create this new regulation that essentially makes the industry that you just invested your money into bust. It makes it void. And that could severely hurt the value of your investment and the chance of you to ever make any money. And this is where you have to understand that investing comes with risks, and there will be times that you lose money. Not there might be times that you lose money, but there will be times that you lose money. But the key is to keep coming back and understand that the goal is to make way more than you lose. Losing is a part of the process. Every successful investor in the history of time has lost money at some point. It's not just you. And you have to understand that the key now to making more money is to keep coming back and keep learning because, well, losing is a part of the process. And again, if you want to keep enhancing your financial education, I have tons of videos on my channel, and you can also check out the ebook that we have at Briefs Media down in the description. Becoming wealthy or financially free is more about what you do with your money after you get paid than it is about how much money you're actually getting paid. Everybody goes through 3 different phases when you're learning how to become wealthy. The first phase is you learn how to save money. You learn how to live below your means. You learn how to be frugal because now you're just trying to put some extra cash aside. That way you have some extra money to build your wealth. Phase 2 is all about growth. You're starting to see a little bit of success because now you have some extra cash, and now you're trying to figure out how do you amplify this? How do you grow your money? How do you attract more money? And how can you actually grow your pie? Phase 3 is all about learning how to spend. How do you spend your money like wealthy people? How do you get the most value out of your dollar? How do you get the most value out of your time? If you really want to enjoy being wealthy, you need to also know how to spend your money, because otherwise you're going to be stuck in that phase 1 mindset, because now you're going to have money in the bank and you're going to have investments paying you every single month, and you'll be able to afford a much better lifestyle. But if you can't get yourself to go out and spend money, if you can't get yourself to go out and enjoy your life and enjoy the luxuries that you can afford, then you're not going to be able to enjoy your wealthy life. Like I'll tell you, for me, I started off by never wanting to go on vacation because I wanted to save every penny possible, phase 1. Then I wanted to take every penny that I saved and invest it as aggressively as possible into things like real estate. That way I could create more cash flow, phase 2. And then I went from now, when I go on a long flight, I don't want to sit in economy. I want to sit in business class. That way I can have some extra leg room. That way I can sit comfortably and sleep on the plane, phase 3. The way that you become wealthy is not by having a fancy degree or by earning a big salary. It's by using your money the right way when you get paid. That's why in this video, I'm going to be going over 5 things that you, especially millennials, need to do right now when you get paid. That way you can become wealthy. But before we get into these 5 things, I need you to do me a quick favor and smash that thumbs up button below. The first thing you got to do when you get paid, if you want to become wealthy, is you have to pay yourself first. See, what the majority of people do is as soon as they get paid, they see the money hit their bank account, and then they call up their cousin Bunty and they say, "Hey Bunty, you want to go to the mall?" Cousin Bunty isn't the best influence financially. So now you go over to the Gucci store, the Apple store, the Lululemon store, and now you pay them. You pay Gucci, you pay Apple, you pay Lululemon, and now your money is gone. You have paid Gucci, you have paid Lululemon, you have paid Apple, but you haven't paid yourself. This is where now the majority of financial advice says that if you want to become wealthy, all you gotta do is take a little bit of your paycheck and put it into your 401k or put it into your IRA. Now, your 401k and your IRA are great investments for average people. But if you don't want to be average, you can't keep investing your money like average people. You have to do more than that. Have you ever heard of a super rich person talk about how they got rich because of the 401k? No. This is where you gotta think a little bit bigger. So when we talk about paying yourself first, the very first thing you gotta do is you gotta create a financial system. And one of the simplest financial systems that you can follow is our 75-15-10 plan, which says that from now on, every dollar that you earn is gonna flow through this system. It's kind of like a funnel where now a dollar flows in, and now you tell yourself that 75 cents is the maximum that you can spend, 15 cents is the minimum you should be investing, and 10 cents is the minimum that you should be saving. So this is what you spend, this is what you grow, and this is what you save. And this is going to be outside of your 401k and your IRA. The best way to go about doing this is to create 3 different bank accounts. And anytime you get paid, you have an automatic withdrawal, which is gonna take the money out of your checking account and move it somewhere else. It's gonna move it into a savings account, and it's gonna move it into an investment account. That doesn't necessarily mean that this money is gonna be invested right away. It's just a separate bank account with money that is supposed to be invested. You don't want to keep all this money in one bank account, because then you might accidentally spend your investment money on a brand new TV, or you might spend your savings on a brand new car. These things need to be separate. That way you know what's for growing to build your wealth and what's for savings. Now, next time you go to the mall with your cousin Bunty, you're not going to be able to give all your money to Gucci and Apple and Amazon, because you already paid yourself first. The second thing you do when you get paid is you need to know how to save your money smartly. So now you're following the system. You have 3 different bank accounts. 75% of every dollar that you earn goes here, 15% of every dollar that you earn goes here, and 10 cents are going into your savings. But one of the worst things that you can do is just save your money forever. So when I was growing up, I was always told that I needed to become a doctor like every other brown person in the world. And the reason why I needed to become a doctor is because I would make a big salary. And the benefit of a big salary is you get to save a whole lot of money. Because now, if you're making $300,000 a year, You can save $250,000 a year and live off of 50. The problem with that, there's a lot of problems with that, but the main problem with that on the savings side is your savings are never going to make you wealthy. Sorry, mom and dad, and sorry, uncle, auntie, but you can never save your way to wealth, especially in the economic environment that we're in right now. When you take $1,000 or $10,000 or $100,000 and you save this money in your bank account, your bank is going to pay you nothing. Your bank is going to pay you 0.01% a year in interest on your money, while the price of things around you, the price of everything, your housing, your groceries, your vacations, your healthcare, the price of all these things are going to grow way faster than 0.01% a year. The price of everything around you is getting so expensive while your savings are just sitting there dead. Your savings are not growing. You can never save your way to wealth. The value that savings have are not to make you wealthy. Your savings are supposed to be there to protect you against a financial emergency. So when something goes wrong, when your car breaks down or your kid's arm breaks, now you have some savings you can fall back on, that we don't got to go into debt to pay for this cost. This is why your savings are here. You have to understand this if you really want to ever have a shot at becoming wealthy. The only reason why you should be saving money is to protect yourself from a financial emergency. If you want to become wealthy, you have to be growing your money. I'll get to that in just a second. But if you really want to understand this, that means you need to know how much money you need to save and never save a penny more than that. That way you can invest every extra penny. So you want to be saving somewhere between 3 months and 12 months worth of expenses, depending on how risk tolerant you are. If you have a higher risk tolerance, then you might only need 3 months worth of your savings sitting in a savings account somewhere. If you're not as risk tolerant and you want to be more safe and more protected financially, then you can put 12 months worth of your expenses in a savings account. After that, you do not want to save another penny because your savings are not going to make you wealthy. So you want to follow this financial system until you hit your savings goal. And once you hit the savings goal, then you want to reroute these savings into your investment money. So now you have 25% of your money minimum being invested, growing to make you wealthy. The third thing you got to do when you get paid is you need to know how to grow your money. Time is your best friend when we talk about growing your money. So if you're young, this is the best time to start. If you can invest $350 a month between the ages of 21 and 31, and that's all you do. You invest $350 a month every single month, and you can get a decent 8% return on your money. And after the age of 31, you don't invest another penny. You just let that money compound at the same rate until you retire. You will be able to retire a millionaire even if you never invest another penny after you turn 31. Now, I'm not saying you shouldn't invest another penny after 31. You want to keep investing aggressively. That way you can build more wealth. But this is the power of time and knowing how to grow your money the right way. So how do you actually go about growing this money? Well, the first thing you got to do is you need to have some cash to invest. So you want to take this cash, put it in a separate bank account. Now we have some money to invest, and this is where you got to figure out your investment strategy. If you want to be completely passive, you don't want to even think about your investments because you don't like doing that, well then you can just invest your money into ETFs on the stock market. If you like the stock market but you want to be more involved, then you can look at individual stocks and investing in. If you want to be more hands-on and you want to get consistent cash flow, then you can invest your money into real estate. You don't have to do just one or the other. I do all three of these things, but you have to understand what your goal is, what your strategy is, and you need the cash to do that. I own rental properties and I'm always looking for more real estate investment deals, and these properties are paying me rent every single month. I also have money in the market where I'm looking for individual stocks. I look for stocks that I believe in, that I think are undervalued, that I want to own for the long term. I put my money into them and then I hold on to them for years. I also have a passive investment strategy where every single week I have some money being taken out of my checking account, going into the stock market, into a few different ETFs. That way I get exposure to the stock market. So you don't have to only stick with one strategy, but you got to start with one, and you got to know what your goal is with each strategy that you do. You got to understand, if you want to become wealthy, this is what is going to make you wealthy. It's not going to be this, and it's not going to be this. You buying nice cars, nice clothes, and a big house is not going to make you wealthy. You going out and saving all of your money in the bank is not going to make you wealthy. If you really want to become wealthy, and I'm not just talking about average wealthy, I'm talking about really wealthy, you need to be focusing here. How can you grow your money more? If you are serious about becoming wealthy, then there are 2 rules that I want you to follow. Rule number 1, before you buy a home to live in, buy a property to rent out. And number 2, anytime you spend $1, invest a dime. The home that you're living in is not going to make you rich. Sure, you can make money on your home if you sell it for more than what you bought it for, but if you really want to become wealthy, you want to think of your home as a liability, as something that you just use, and you want to think of rental properties as an investment, because these are things that you're buying for the sole purpose of making money, and they will pay you every single month as you wait until you sell this property. One of the biggest changes that you can make is before you go out and you buy a home to live in yourself, you go out and you buy a rental property. Then after you have this rental property, then you can think about buying a home, and now the rental property that you own will pay for your mortgage for you. And once you start to see the type of cash flow, you're gonna want to do it again and again and again. That way you can ramp up that cash flow, and now you have cash flow producing assets that are paying for your expenses. I didn't grow up learning about real estate investing or passive income or investing in general. This was something I fell into. When I was 19 years old, I invested into my first real estate investment property. I was in college, I had some cash in the bank because I was running an event planning business at the time, and this was back right after the real estate crash, the 2008 crash. So real estate prices were rock bottom. I had no idea what I was doing, but every book that I read, every wealth book that I read, said that wealthy people own real estate. I had no idea what that meant because I didn't know any real estate investors, but I went out and I bought my first property. It was a small little condo. I wasn't going to live there myself. I was renting it out to somebody else, and this condo, after paying all of my expenses, put $250 into my pocket every single month, and after getting it all situated, I didn't have to do any work. This was cash flow coming into my pocket every single month, whether I went to work or whether I didn't go to work. Remember, your wealth is built here. It's not built here, and it's not built here. So if you want to become wealthy, you have to put extra emphasis on putting your money into places where you're gonna be getting paid. The second simple change that you can make is anytime you spend $1, invest a dime. Before you go out and you spend $1,000 on a brand new iPhone, take $100 and invest it into the Apple company. Next time you go out and you spend $20,000 on a brand new car, take $2,000 and put it into the car company. Now what you're doing is you have a producer first mindset. You're not just thinking about spending your money, you're thinking about owning the asset where you're spending the money. So now you're shifting your mindset from just a consumer to a producer. You're building that wealth mindset, and you're really putting your money where your wallet is. The fourth thing you gotta do now as you get paid, as you start to build this wealth, is you gotta know how to spend your money like wealthy people do. Here's the thing, wealthy people are not drowning themselves in debt just so they can buy Rolex. And they're not stretching themselves thin to go and buy a Gucci wallet, and they're not opening up a brand new credit card to go shop at Louis Vuitton. So when we talk about spending like the wealthy, the first thing you gotta understand when it comes to these things, which are luxuries, liabilities, things that don't put any money in your pocket, no more financing these things, period. If it doesn't put any money in your pocket, you should not be financing it. Second, when it comes to these things which don't make you any money, which are not necessities, you gotta know what you can actually afford, because there's a difference between being able to buy something and being able to afford something. You can walk into the Apple store and walk out with a $1,000 iPhone by paying only $50 today. But just because you can qualify to buy something does not mean that you can afford it. If you want to be able to afford something, the easiest thing that you can do is just follow a rule of 5, which says if you cannot buy 5 of them, you cannot afford 1 of them. Now, as you start to build your wealth, you're gonna get a little bit more sophisticated. How can you use your money to give you the most value? How can you use your money to enjoy your money? Because now you're becoming wealthy. Well, the first thing you gotta do is you gotta make sure now that you're protecting your assets. You wanna make sure that you're protecting your wealth. That means having things like insurance. It's a small price you pay today to protect you against a big headache in the future. That means having things like wills and trusts. That way you know how your money and your assets are going to be divided after you die. The reason why I'm telling you this is because I'm a licensed attorney. I've heard of horror stories of people dying with a lot of money, a lot of assets, with no will, no trust, and no direction on what to do with their money after they die. And now you create this huge family fight, this financial mess, and then the government comes in and they have to decide what to do with their money. You don't want the government telling your family what to do with your money, so think ahead and start thinking about how to protect your assets. Now, when it comes to protecting your family, the goal is for you to have assets that your family can fall back on. That way, even if you were to die tragically, your family would have assets that they can rely on financially, so at least your family would be okay. Until you get to that point, you want to have life insurance as protection for your family, because if you are a breadwinner for your family and you were to suddenly die tragically and now your family lost your stream of income, you want to make sure that your family can still afford their lifestyle, they can still afford their standard of life without your income. The way you can do that is by having something like life insurance, because the way life insurance works is if you were to die unexpectedly within your life insurance term, then your life insurance company would come in and they would give your family a big check. That way at least they're okay financially. The good thing about life insurance is it doesn't have to cost you a whole lot of money either. Like if you're a healthy 30-year-old guy, you could get $1 million life insurance policy for something around $30 a month. Now, when we talk about spending money like the wealthy, the thing that you have have to remember is that you can always get more money, but the one thing that you cannot get more of is time. So when we talk about how to use your money smartly now, you want to use your money in a way that's going to get you the most value out of your time. Because we were talking about real estate investing just a minute ago, let me give you an example of what I mean through real estate investing. So when you invest in real estate, the way it works is you buy a rental property, and then somebody's going to live in this property and they're going to pay you rent every single month. Now there's two ways that you can manage this property. You can manage this property yourself, so you have to find the tenant, you have to qualify the tenant. Anytime something's wrong with the property, the tenant's going to be calling you, and it's going to be your responsibility to pay all the bills and to make sure all the day-to-day things are done with the rental property. The alternative is you can hire a property management company. They'll charge you somewhere between 4% and 10% of your gross rental income, and in exchange, they'll make it completely hands-off for you. They'll find the tenants, they'll qualify them, they'll deal with all the headaches that come with managing a property. So if the toilet breaks, your property management company will be the ones that fix it, and they'll be the ones that pay all the bills. So all you gotta do is find the properties and give the keys to your property management company. A lot of people, when they get started with real estate investing, don't want to pay $100 a month to a property management company because they say, hey, I can just do this myself. But the thing that you're sacrificing to do it yourself is you're sacrificing your time. This is something that you can't get back. And so you got to remember, what do you want to be in the business of? Do you want to be in the business of managing your properties, or do you want to be in the business of finding more investment deals? Now, as we're talking about spending your money like the wealthy, what you want to do is you want to use your money to free up your time. That way you have more time to do whatever you want. And maybe that thing that you want to do is do more things that will attract you more money. So when we talk about spending like the wealthy, you got to figure out which things are important to you. Do you like luxury? Do you like having more free time to spend with your family? Do you like going on exotic vacations? Figure out the things that are important to you and be okay spending your money on these things, because this is what you're working so hard for. This can be hard if you really get stuck into the whole idea of trying to save every last penny. That's how I grew up. I grew up being told that I need to save as much money as possible, that I should not waste money, that I should not spend more than I need to. But then as you start to see more financial success and you want to start enjoying your money, you want to be okay spending your money. I've been spending a lot of time in Airbnbs recently. And most recently, I stayed at an Airbnb in Chicago for just over a month, and I could have gotten an Airbnb for a couple $1,000s, but I wanted something nicer. I wanted something where it had a nice city view and a great location. So instead, I picked an Airbnb that cost me more than $10,000 for 1 month. Now you can hear that and say, oh, who the heck needs to pay $10,000 for 1 month just to live somewhere? And you're right. You can live somewhere a whole lot cheaper. But I didn't want to do that. I wanted a nicer location. I wanted a nicer view, and I wanted a nicer unit, and I could afford it because of the previous steps that I talked about. I still got that voice in the back of my head saying, Jaspreet, why are you wasting so much money? But it goes back to this. Spending money like the wealthy. What are you working so hard for? And being willing to spend money on the things that are important to you and that give you the most value in your life. And this brings me to the fifth thing you need to do when you get paid. Now you have a financial system. You know how to save, you know how to grow, you know how to spend. But if you want to get there faster, you need to put more money into your funnel, which means you got to know how to earn more money. Now there's a couple of aspects to this. You have the financial aspect and you got the time aspect. The financial aspect might be investing in classes, investing in books, investing in more education, so you know different ways that you can earn more money. It could also mean investing in other businesses. Maybe you're going to buy a business. Maybe you're going to buy a part ownership in a business. This way you have more money coming in. There's a lot of different things you can do. The internet makes this more accessible than ever, where now you can create a side hustle doing what you love. You can create a blog, you can start a podcast, you can start a YouTube channel, and these are all things that as you start to grow them will create a new stream of income for you. On the time side of things, you got to decide how much time you really want to devote to earning more money. Because if you do want to achieve this financial success faster, you are going to have to earn more money. And one of the ways you can do that is by investing more time into things that can earn you more money. That means maybe you're going to spend more of your time building a side business or building a second business. All the things that I just talked about are more accessible than ever, but that doesn't mean it's easy. You have a lot of people on the internet that are trying to create content, that are trying to get eyeballs on them, that are trying to make money on the internet, but the people that really make it are the people that invest back into their education. That way you can learn how to actually make money. You know the formula, you know the system, you know what it takes. Now what you have to do is you got to amplify the system. How do you get there faster? The way you get there faster is by throwing more fuel into the fire. In this case, it's by putting more money into the funnel. The way you can get more money is by investing more of your money and more of your time into things that will earn you more money. Everybody loves it when it's your payday. You love it when it's your payday, the Gucci store loves it when it's your payday, and even the government loves it when it's your payday because that means they get paid too. But what ends up happening to so many people is payday comes, you get excited, you start spending your money, and by the time next payday comes, you spend almost all of your money. Or maybe you decided to splurge on that extra guac and now you have no extra money.